Let's talk about one of the most frustrating, kind of confusing moments in leadership. It's a paradox that trips up even the best managers, what I call the illusion of profit.
Okay, picture this. You're a department head and you just absolutely crushed your quarterly goals. The income statement, it's glowing. Record profits. You walk into your boss's office all ready to pitch that brilliant new hire who's going to take your team to the next level. You make the case, you point to those fantastic numbers, and the answer you get is a flat no. We just don't have the cash. How? How can you be so profitable but have no money to spend? It's a moment that drives leaders crazy, and it all comes down to a huge misunderstanding of what profit actually is.
All right, let's get right into the big idea for today. And if you only remember one thing, make this. Profit is an estimate. Seriously, it is not cash in the bank. You see, finance is as much an art as it is a science. And that profit number on your P&L, well, it's the result of dozens of choices, assumptions, and judgments made by accountants who are following a very specific set of rules.
Now, why does this matter so much? Well, because if you treat that profit number like a hard fact, you are going to make bad decisions. Simple as that. Understanding that it's an estimate is the very first step toward real financial intelligence. It's how you get beneath the surface to see what's really going on with the health of your organization. And that, of course, is absolutely critical if you want to be a faithful steward of the resources you've been given.
So today, we're going to pull back that curtain. First, we'll learn to read the story your profit and loss statement is telling. Then, we'll get into the art of finance, like how revenue and costs actually get counted. And finally, we'll see that profit isn't just one number, and what each part of that story truly reveals.
First up, let's get to know the document where this whole idea of profit lives, the income statement.
You'll probably hear it called a few different things. The income statement, the P&L, the statement of earnings. They're all the same thing. Just think of it like a report card for a specific period of time, like a month or a quarter. It tells a simple story. Here's what we brought in, here's what we spent, and here's what was left over. But as we're about to see, how you tell that story involves a whole lot of, let's call it, artistic license.
And that artistic license? It starts with the very first, and you could argue, the most important decision in all of finance: timing. Specifically, when you get to count your revenue.
Now, this is where things get really interesting. Your common sense might tell you that you've made money as soon as a customer pays you, right? The cash is in hand. But that's not how accountants see it. The big rule here is that revenue isn't recognized, which is just a fancy word for counted on the P&L, until it is earned. And you only earn it when you've delivered the product or you've performed the service. So the cash might show up in January, but if the service is delivered over 12 months, you can only count 1/12 of that money as revenue each month. It's called the matching principle. You've got to match the revenue to when you actually did the work. And it's everything when it comes to understanding your P&L.
Okay, so the timing of revenue is one part of the art. The next part is just as important. It's not just about when you count your money, it's about how you classify what you spend.
This is another one of those choices that has a huge impact. Let's say you spend $50,000. Was that an operating expense or a capital expenditure? Well, if it's an operating expense, think day-to-day stuff like salaries, the full 50 grand hits your P&L this month and reduces your profit right now. But if you classify it as a capital expenditure, a long-term investment like a major new piece of equipment, it doesn't hit the P&L directly. Instead, its cost gets spread out over several years through something called depreciation. You see that? The same amount of cash leaves your bank account, but the impact on this month's profit is totally different. Now, this is a legitimate accounting choice, but you can immediately see the temptation, right? There's a lot of pressure to classify things in a way that makes today's profit look a little better.
So if revenue can be timed differently and costs can be classified differently, it kind of makes sense that profit isn't just one single number at the end. In fact, there are several different kinds of profit, and each one tells a different part of the story.
You know, smart leaders never just skip to the bottom line. They look at the whole profit story. First up, you have gross profit. This is your revenue minus only the direct costs of what you sold. This number is huge. It tells you if your core product or service is even priced correctly. Next, you subtract all your operating expenses, like salaries and rent, to get your operating profit. This shows the health of your core day-to-day business. Then, after you subtract everything else, like taxes and interest, you finally get to net profit. That's the famous bottom line, but as you can see, it's the end of a long story with a lot of chapters.
Okay, that's a lot of theory. Let's make this super practical and see how these ideas play out in the real world, first in a business setting and then in a ministry.
So think about a software company. They sell a yearly subscription, and a customer pays them $12,000 upfront on January 1st. The company has the cash, which is great, but they haven't earned it all yet. They earn it by providing that software for the next 12 months. So to give a true and stable picture of their performance, they only recognize $1,000 in revenue each month. I mean, can you imagine if they counted all $12,000 in January? That month would look amazing, but the next 11 months would show zero revenue from that customer. That would be completely misleading.
All right, let's bring this into a ministry setting. Say a church is hosting a big conference in July. They're smart, so they collect all the registration fees way back in April. The cash is in the bank, life is good. But the really big expenses, the venue, the speaker fees, those don't get paid until July. A financially intelligent leader insists on matching the revenue to the month of the event. Why? Because the only way to know if that conference was a good use of resources, if it actually paid for itself, is to see all its income and all its expenses in the very same snapshot. That's just good, honest stewardship.
So the big takeaway here is you don't have to be a passive observer of these numbers. You can and you absolutely should engage with them. So here's a simple playbook to get you started, whether you have a finance team or you're doing it all yourself.
If you're running the budget yourself, I want you to start building these 3 simple habits. First, in a basic spreadsheet, track your cash balance right next to your profit number. Watching the difference between those two will tell you a powerful story. Second, anytime you make a big purchase, stop and ask yourself that key question. Is this a short-term expense or a long-term investment? And third, please never overreact to 1 month's P&L. Look for trends over 3 to 6 months to get a real feel for what's actually happening.
Now, if you're lucky enough to have a finance team, your job is to be a curious and informed partner. Don't be intimidated. Just ask good questions. Things like, hey, can you walk me through how we're recognizing revenue for this new contract? Or, what are the biggest assumptions or estimates that are baked into this profit number? Or even, I noticed our marketing spend looks lower. Did we reclassify something? These kinds of questions show you're engaged, and they will absolutely help you lead more effectively.
And you know what? Once you start asking those questions, you'll naturally start to avoid the common traps that so many other leaders fall right into.
So let's just recap the 3 big pitfalls to watch out for. Number 1, never ever confuse profit with cash. We've seen how that leads to that frustrating meeting we started with. Number 2, look beyond the bottom line. The whole profit story is what really matters. And finally, number 3, remember the big idea. Never treat the P&L like it's some infallible fact. It's a story, and your job is to learn how to read between the lines.
At the end of the day, this isn't really about becoming an accountant. It's about leadership and integrity, seeking to understand the story behind the numbers, to really count the cost, not just with technical accuracy, but with real honesty. That is a profound act of stewardship.
When we do this, we're making sure that we are making decisions based on reality. We are building our teams, our businesses, and our ministries on a firm foundation of truth, not on the shifting sands of a misleading estimate. So here is your challenge for this week. It is simple, but it is so powerful. Pull up your latest P&L. Find just one number on it, just one that you don't fully understand, and then go ask this simple, powerful question. What's the story behind this number? Just start there. That's how you begin the journey to true financial intelligence.